Thursday, May 14th. And our topic today is cash flow, how to build financial plans for your business that work. And joining me in this conversation is Joe Greenhalgh from CFOs to Go. And we'll be talking about what business leaders should be thinking about in this challenging business environment filled with uncertainty. Joe will talk about the importance of building financial plans that actually work and can guide our businesses through this crisis and improve our chances for success. Now, as a fractional CFO, Joe works with leaders of small to mid-sized companies, and he has many years of experience in this field, having worked over 20 years at a well-known publicly traded company in the consumer electronics space. And during his tenure, he helped that company scale from 300 million to 2.4 billion dollars of sales in less than 10 years. And following the 2008 financial crisis, he helped the company through multiple restructurings and an eventual return to stability and growth. And that makes him uniquely qualified to guide us in this conversation on the importance of having cash and building financial plans that work to help our businesses survive this difficult time and succeed beyond it. So, with that, I'd like to bring Joe into conversation. Hi, Joe.
Hey, Roman, how you doing?
I'm doing well. Thank you. It's good to have you. Thanks for joining us.
Sure, thanks for having me.
Joe, and the topic again today is cash is king and building financial plans that work, which is something that you and I talked about before, and you had mentioned the significance that cash has on the decision making around the financial planning that we have for our businesses. So I'd like to start our conversation with that. Why is cash still king in business planning?
Well, I think it's been said many times. Cash flow is really the lifeblood of every business. If you run out of cash and you don't have access to additional sources of funding, the truth is your business dies. And I think we've already seen some of that happen over the last 6 to 8 weeks here, and unfortunately, I'm sure we'll see more, just given the impact that economically that the pandemic has had. I think what every company really needs, they need to have a thorough understanding of their cash runway for at least the next 3 to 6 months, and that means they need to have an understanding of that for not just one set of assumptions, but for multiple. Because the truth is, we don't know how things are going to evolve over the next 3 to 6 months, so you need to be prepared for multiple scenarios there. And I'd say that the key to doing that, it's unfortunately you can't just sit down and say, okay, I'm going to do my cash projections today. Having a credible and useful set of cash projections requires really that you start with coming up with projections for your income statement. So you need to model sales. You need to model what your margins are going to be, what your spending is going to be, and you need to be able to do that under multiple scenarios. And when you've gone through and done that, then you actually have a more credible picture of what your cash is going to be. So I think that's really the key. It's the output of a detailed process. It really starts with how much you're selling, how much you're spending, and how much profit are you generating. So I think that and as part of that, a really important part of it, given its impact on cash, is to focus on discretionary spending. What are the things companies are spending money on today that they actually don't need to? Things that they don't get that much value out of. Lots of companies pay on a monthly basis for different kinds of services that they just pay because they've been doing it and they assume it's useful. But at the end of the day, those are the kind of things that really you might want to stop or defer entirely. Because I think, one thing that typically happens in a downturn is that cash and profit fall a lot faster than spending, which, given the fact we don't know how long this is going to go on, getting control of spending immediately is absolutely critical.
Now, these are really good points, and it kind of sets the stage to ask the question, is financial planning, doable right now, or is it the right time? Because no one could have planned or foreseen how quickly this pandemic sort of unveiled and how it really constrained and shut down our usual businesses. And I know a lot of businesses do financial planning for various reasons, but with how much uncertainty we're still facing and the lack of clarity of knowing or seeing when this might be over, how it's going to play out over the next few months, is this the right time to do planning? Um, Knowing that some of the plans that we put in place might very well be wrong.
I think it's a great question, and certainly an understandable perspective, given the fact it's hard to know where we're going to be 2 to 3 weeks from now, let alone 2 to 3 months or longer. But I think that one of the potential misconceptions about doing a financial plan is it's about predicting the future. The truth is, if you could predict the future, you wouldn't waste your time doing a plan. You already know what the output is going to be, so you might as well focus on something more productive. Unfortunately, most of us aren't able to predict the future. So the value in doing a plan is it really helps prepare you for whatever form that future might take. And that really means that when all is said and done, as you said, a lot of the detailed planning assumptions that are going to go into your financial plan are going to prove to be wrong. There's no question about it. That's just the nature of planning. But the hope is, and the goal is, that if you're doing this for multiple scenarios, that what you end up from a total company perspective is an approximation of what the company's results would be. And I think one of the biggest benefits that you get out of that, which really an indirect benefit, but in going through the planning process and looking at multiple scenarios, it really gives the management team an understanding of the levers that they have available in their business from a financial perspective, to respond when things are different than planned. And I know in today's kind of environment, we all think about things are worse than we would have expected. But the reality is, in a better economic period, things could be better than expected. And if a company's already thought through the kind of things they can do, for example, if sales are higher than expected and they need to buy inventory and they don't have enough cash to buy all that inventory, if they've already thought through the actions they can take when it comes to paying some of their suppliers and getting extended payment terms or collecting their receivables faster, they're in a better position to respond than they would be if they just said, well, this whole planning thing is kind of a waste of time.
All right. Well, that's a fair answer, and I wouldn't expect anything less. But as you think about these different scenarios that businesses should be thinking about, which ultimately is the value of doing these types of planning exercises. I mean, what's a practical number of scenarios that a business should include in their financial plan?
Well, I think since we're mostly talking about smaller businesses, there's kind of a trade-off here in terms of diminishing returns depending on how
Mhm.
much you're doing. I think it's reasonable, if nothing else, to have kind of at least take a look at three different scenarios. Take a look at what you think, based on what you know today, might be worst case. Take a look at what you think is hopefully what's actually going to happen, and then take a look at best case, and be prepared. As a result of going through that process, you'd be prepared to go ahead and act depending on how things actually turn out to be. And if it's way better than you thought or way worse, at least you had a plan in place that got you, thinking about what you do in those kind of circumstances.
And wow, that's a good point. So best case scenario, worst case scenario, and sort of somewhere in the middle.
Yeah, I think that's a reasonable approach. I mean, obviously, huge companies are going to have, all kinds of statistical models they're running and looking at multiple kinds of scenarios, but
Mhm.
that's well beyond the realm of what's reasonable for smaller companies or necessary for that matter.
Well, and that's a good point, because earlier on you had mentioned that the value of financial planning is that you get to see all of these potential outcomes and that help the executive team make decisions. And so I want to come back to that specific thing that you said, the executive team, right? The size of the business will determine the size of the executive team. And in a smaller business, that very well may be a team of one or maybe a couple of people. So I know that you generally work or advise companies in the 50 plus $1 million of revenue. But what would you say for some of the smaller businesses as well as mid-sized businesses? Who are those key decision makers that should be involved in the financial planning process to give their perspectives on what these various outcomes should entail?
Sure. So I think, just to clarify, I think that, the size companies I would typically work with would be a little smaller than that. So I'd say that the most likely is going to be somewhere annual sales of somewhere between 10 million and 50 million. Um, and to your earlier point, yes, executive team in those companies in many cases is the CEO. But I think that beyond that, CEO, yes, absolutely. Do they have a CFO? Obviously, if so, you'd want to include that person. In those size companies, it's not always the case that a CFO would be there. You'd want to include whoever the most senior finance person is, unless that's somebody who is really just functioning as a kind of a senior bookkeeper, in which case they may not be able to add as much value. But the people who are responsible for, essentially sales slash marketing, and production and operations, I would say those people are absolutely critical, regardless of what their title is within the organization. Those are the people that are in contact with customers, and those are the people that are responsible for making sure the company can deliver the products or services that they have. So, at a minimum, I would say those, kind of that troika right there is a group that needs to be involved, because the worst thing in the world is to have a CEO who believes that he or she knows everything about the business, but they're not close enough to the day-to-day details that, if they were, they'd understand that some of the things they think they should be able to achieve aren't realistic, or maybe aren't as good as they could be if they push a little harder.
Well, so then that's a good point. So it's having the different perspectives, but also I think the CEO needs to be open to letting those folks um, have a say in what they're looking at and what they're observing, so that they're not blinded by their own kind of perspectives. Are there any
Yes.
other sort of surrounding external advisors that you would generally recommend that the CEO or that small group of advisors internally consider, or whose opinions they should consider in building these plans and running of different scenarios?
So you mean the people outside of the company?
Yes.
Uh, well, I think that, speaking selfishly, I think talking to a fractional CFO never hurts to get the financial perspective.
Hmm.
I think on the legal side as well, it's also important to be talking. If you don't have an in-house general counsel, make sure you've got someone from a senior legal perspective involved, whether that's someone you've worked with on a transactional kind of basis, or someone who's acting as kind of an outsourced general counsel, because there may be things you're considering doing that could have a significant impact from a legal perspective. And I say also on the HR side, that was probably an oversight on my part to skip over HR. But I think if the company has a senior HR person who is working closely with the management team, absolutely that person should be involved in those conversations. And if they don't, there are plenty of very, very experienced and helpful HR professionals who can help with that as well. Because it's obviously you want to be taking a very broad perspective of how you're planning the company to act and the kind of things you're going to do, and make sure you've considered all angles of how that might impact both not just the financials, but also employees and customers.
Um, that makes perfect sense, Joe. And I guess when I think back to some of the conversations that I've had with our business owner clients and about some of their plans as they see the near term future unfolding, um, you'd mentioned there are sort of different types of financial plans that can be thought through. Can you spend a little bit of time talking about that as well?
Sure. I mean, I think at a high level, I'd say there's really two fundamental kind of plans. One is, I call it a static plan,
Mhm.
and the other one I'd call dynamic. The static plan, I think, is kind of the traditional way of planning and budgeting, and that's basically as you approach the start of the new fiscal year, you do a budget for the next 12 months, and everybody works real hard on that, and then they're glad to reach the finish line, and it's over with, and everybody forgets about it for a year. And the problem with a plan like that is obviously that nobody really cares about what's there, because the assumption is that it's going to be wrong 3 to 6 months into the year anyway. Um, and so as a result, I think people end up viewing that as really kind of a waste of time. And it becomes a check the box exercise of let's get this ridiculous plan done so we can get on to doing something important. Um, and understandably, that's the way people would view it. I think
Mhm.
that that kind of a plan works in those rare environments where it's a very stable, non-volatile kind of space, and the future is predictable. And I think I can't think of any sort of industry or company right now where that would actually be the case because it's just not predictable from here. So I think the other kind of plan, which I think adds a lot more value, is I'd called it a dynamic plan. It's also referred to as a rolling forecast. So the idea is that plan is part of a continuous planning cycle that gets updated periodically throughout the year. So for most companies, that's going to mean they're going to do it once every 3 or 6 months. And that's basically go through that planning cycle again and revise what the next 12 months looks like based on what you know today. And I think that on the one hand, it sounds like a lot of work. On the other hand, the value of that is because you're going through that process on a regular basis. You're gathering, what I would call actionable intelligence about the company, about its market, about its customers, and you're able to act on that during the year. And you can use that to, adjust resources to the right places in the company, decide if there's new products you want to move into at this point in time, or if there's things that you should discontinue. But you're actually making it a living, breathing document that you're using not only to understand where you're at, but you can also use it to really measure your results and to drive accountability across the organization.
All right, I want to put you on the spot or reveal anything that shouldn't be revealed. But what would you say is a percentage of businesses or companies that you work with where you see that split between having static plans versus having dynamic plans? And that's before your engagement, but just generally, what would you say is the split between the two?
I would say in general for those companies that have a plan, more of it's going to be the static variety.
Mm.
And in many cases, they prepared it for an external audience, whether that is, they've got investors or whether they have bankers they work with. And as I said kind of earlier, it becomes a bit of a check the box exercise. And I completely understand that because smaller businesses have their hands completely full just dealing with day to day reality and having to keep the ship running. So I think it's in no way intended as a negative, but I think they do potentially miss out on some of the benefits of having a plan that can guide them a little bit as they move through the year.
Yeah, Joe, can you give a kind of a high level overview of the process that you might take a company through in building a more useful dynamic plan?
Sure. Well, I think as I probably alluded to earlier, the starting point with that is really going to be on the income statement side of things, which means you really want to start with sales. So you'd want to get with whoever the sales leader is in the company, whether that's the CEO or someone who's actually driving sales. Understand what the customer base is, how often they're buying, why they buy, why they don't buy, and work with the marketing side of things to the extent that's one person. That's great. I mean, it's easier to work with, but understand the promotions their company's going to put in place, what they expect their sales to be over the next 6 to 12 months, and why. And as I said earlier, look at that under multiple scenarios. And then I think you just move down the income statement from there. So you're also going to look at on the production side. If it's a company that has products, you want to really understand the cost of goods sold and how much you're paying for your inventory, how much you're paying for products to be assembled, and what are your margins looking like under a variety of assumptions. If it's not a product company, it's a service company, then I think it's you don't need to worry quite as much, obviously, about the cost of goods sold, but you certainly want to worry about how well you're utilizing your employees. What's their ratio of billable hours to non-billable hours, and I think then that brings you to the spending piece as well, which is we've kind of touched on, and that is what are you spending money on? How much more do you need to spend to drive some of those top line assumptions you've made? Do you have ways to measure the success of your marketing spend? Everybody understands the need to promote their products and services. They don't necessarily understand the importance of trying to look at the ROI on some of those investments.
Mhm.
look at, obviously, and payroll is a big part of this as well in terms of the size of the organization. For the different assumptions you have about how much you can grow your top line, do you have enough people to support that? And if not, what kind of people do you need? How long does it take to get them? And from there, you want to make sure you have the infrastructure, not just on the sales side, but you want to make sure you have the infrastructure across the whole company to
Hmm.
support whatever your growth objectives are. So I think once you get through that and you get a chance to see what the bottom line looks like under different scenarios, then I think you've got a good sense of whether that's something you can live with or that's something that you want to change because you don't think it's the business you want, or you don't think it's realistic, and you want to have something that really feels like a better fit to you.
Um, I was going to ask of sort of at some point in this conversation, why would a business that doesn't have a dedicated CFO consider working with a fractional or outsourced CFO? And that answer pretty much answered that question because I cannot imagine, well, I can, but I don't want to, how difficult it must be to have all of these conversations and pull all of the data, then think through all of that alone, or even in a room with only a handful of people without having that outside perspective. So, despite the
Yes,
fact that I know the importance, I would like to ask you to take a moment and talk about the work that you do as a fractional CFO, and what type of companies should engage uh, a fractional CFO like yourself, and the kind of things that you would help them with, in addition to what you had mentioned.
sure. Well, I think you know, as you mentioned at the start, I work with CFOs to go. We have a little over 20 fractional CFOs based here in the Bay Area. Each one of us has kind of their own area of expertise, which tend to be industry specific. So we have people who specialize in healthcare and life science, food and beverage, nonprofit, family office, et cetera. So I think that the benefit of working with a fractional CFO, well, I've talked a lot about the planning side, which is for me kind of my passion and where I really feel like I can add the most value. There's lots of areas in finance where there are other resources that can be very helpful. So, companies that are looking at, having a hard time acquiring funding, and aren't really sure how to go through that process and aren't sure, where to reach out to. There are fractional CFOs who can help with that. Companies that feel like their accounting is completely out of control. They don't really understand what's going on, and they're not happy with either their in-house bookkeeper or someone they're using externally. That's something that a fractional CFO can come in and set up for them, to make sure that their books are in order and that they
Hmm.
feel comfortable with the numbers they're getting, that they're right. And there are fractional CFOs who can help from a strategic finance standpoint, and thinking about what's the company's exit strategy, what do they need to accomplish to get from where they are today to what that exit point would be,
Hmm.
and what are the advisors they need to help them along the path. So I think finance is a broad area, with a lot of different people out there with expertise in a variety of areas that I think can help. So I think there's lots going on financially in every company where if they don't have a CFO, there's probably not much downside to talking to a fractional one, just to make sure that there's nothing they're overlooking that they might be able to benefit from, by talking with one of those folks.
Joe, what would be kind of the one question, or maybe a couple of questions, that CEOs should ask themselves to think about and decide whether they would benefit from working with a fractional CFO?
Sure. Well, I think one would be, do they understand the financial information they need to run the business? Do they even know what that is?
Hmm.
And because a lot of times, what CEOs get, or is they get an income statement and a balance sheet and a cash flow statement, which to the average finance person, that's helpful. It explains a lot, but
Mhm.
for somebody running a business, it doesn't really tell them anything about what's going on underneath those numbers, and why they are what they are. And I think that's an area where there definitely can be a benefit to that. Um, and I think that um, beyond that, and I'm sorry, Ron, if you could repeat the question, I had a momentary distraction here.
No, no problem. Well, I think impartially answered it, but it was sort of what questions or
Oh yeah, okay,
at what moments should the CFO consider then bringing in or reaching out to a fractional CFO?
right. Right. So I think that, thank you for that. I think the first question, I mean, the first one, as I said, was
Hmm.
do they have the financial information they need? Do they know what
Right.
financial information they need to run the business? And are they getting it? I'd say a second one is do they know what the top three financial issues are in their company? And do they have a plan to address them? And that obviously, maybe planning is one of those issues, maybe accounting is one of those issues, but they really should know what those issues are. And if they don't, that's a perfect opportunity to bring somebody in who can do an assessment and look at their business and say, hey, no obligation here, but you might want to take a look at these three things because I think they can all be done better than they are today.
Right. Well, I think, and it's a tough question to answer in part because I think most CFOs of those smaller to mid-sized businesses have their hands full, and oftentimes they're wearing multiple hats. And it's sometimes difficult to stop and evaluate, objectively all of these key underlying, questions that they should be asking themselves in
Right.
order to determine who they need. And so I think that's in part why a lot of CEOs and leaders of small and closely held businesses and mid-sized companies rely, on a team of experts. And sometimes they're internal, sometimes they're external. And you've mentioned some of them earlier in this conversation. Um, but I know that you are very active in the professional community, and a lot of outside professionals are often the ones who are bringing you in to speak with the CEO. And I wanted you to take just a moment and tell us who are those typical professionals that generally work with a company, and sort of what kind of things should they be looking out for from their kind of outside perspective looking in, um, to spot areas where they might want to bring in someone like yourself as a fractional CFO to then, ask these questions of the leadership.
Yeah, so I think the types of advisors, I think someone such as yourself, who's in the kind of the wealth management and personal financial planning side of things, frequently are working with CEOs of small companies and would have good insight to some of the things that those folks are struggling with. I think fractional general counsels, fractional chief marketing officers, chief operating officers. I think those are folks as well who are close enough to a business to see what's going on there from an outside perspective, and have enough credibility and a strong enough relationship with the CEO that they can make suggestions on bringing in somebody else to take a look from a financial perspective. I think some of the signs to look for. I think one of them, from an accounting perspective, is kind of as I mentioned earlier, that the accounting is completely screwed up. Companies aren't getting the CEOs aren't getting the financial information they need to understand the business. By the time they find anything out financially, it's too late to do anything about it. I think companies that are struggling, obviously, to identify what the future looks like from a financial perspective. If a external advisor is talking to someone and says, "Hey, so what do you think the next 3 to 6 months looks like?" And the person gives them a blank stare. I don't know. I'll do the best I can to figure it out tonight. I think that's another sign that there's challenges. If companies are having problems from a cash perspective, if they're running out of cash, if they're worried about being able to meet payroll, if they're finding themselves going to their bank and using a line of credit that they didn't think they'd have to, I think those are also signs that there's a need for some little bit more proactive review of what's going on the financial side before a company runs into a situation where they really hit the wall and don't have enough cash to do whatever it is they need to do. And I think probably the last one would be any company that's thinking about exit strategies and doesn't have a CFO. Obviously, exit strategies is going to involve a lot of different advisors, but that's if a company's talking about that and doesn't have a senior finance person, I think that's also an indication that they should be talking to someone outside.
Great. So, one of the things that you had mentioned was the one before last were signs of cash concerns. And that's sort of where we open. Cash really is king. And I think when companies, as you've mentioned, have um, enough resources, enough liquidity, enough of a safety net, then they have the benefit of being able to take a step back and think more creatively on how to best navigate, whatever crisis is in front of them. And the one that we're all facing is not insignificant for a lot of businesses.
Right.
So, from a cash, I guess, perspective, I understand the reason why it's important. Can you talk to us about some of the practical things that businesses and business owners and leaders can do, from a cash perspective to strengthen their hand and improve their businesses?
Sure, absolutely. I mean, I think from a tactical perspective, um, I recommend starting with the looking at the balance sheet, which is you find really the three main drivers of cash. With the first one being accounts receivable, the second one being inventory for companies that have products, and the third one being accounts payable. So on the receivables side, the goal with receivables is to collect your cash sooner. And if you have customers that are paying on time, that's great. But for some of the larger ones, you might want to consider offering them cash discounts to pay sooner. For customers who aren't paying on time, it's extremely important to be in contact with them, find out if there's ways maybe to put them on a payment schedule, and even consider, depending on the size of the balance, whether you want to offer a discount to get someone to pay you now as opposed to 2 or 3 months from now. I think on the inventory side, if you do have inventory, you want to convert that inventory into cash as soon as you can, because if it's just sitting in a warehouse, it's cash you spent, but you're not getting any value out of it. So I'd recommend focusing first on slow moving products. Those are the ones that are, they're gathering dust, and they're costing you more by the day. So look at some, maybe taking some pricing action on those products. And if you're worried about hurting the brand, there's alternate sales channels you can use where you won't necessarily damage the brand, but you'll be able to move the product at a relatively low price and get some cash out of it. And then I think on the accounts payable side, the goal here is you want to hold on to your cash for as long as you possibly can. So it's a good time to be talking to suppliers about extended payment terms. And I think it's also a time to not to be paying your suppliers early unless they're giving you a cash discount. Because in this kind of environment, I think the goal of every business has to be to survive and to preserve the business they have. And by paying some of your suppliers earlier, without getting a cash discount, you're in essence doing more to help them than you were to help yourself. And I think beyond the balance sheet topic we've already touched on, but I think discretionary spending is one that definitely need to take a look at and stop or defer or delay anything you possibly can. And then obviously payroll is typically the biggest portion of most company spending. And as painful as it can be, now is the right time to be looking at, okay, should I be reducing salaries? Should we be furloughing people? Should we be considering layoffs? It's painful to do, but if it allows you to preserve the business into the time when things start to improve, it's definitely something that I think needs to be on the table. And I guess the last thing I would say is that um, this situation, whatever it evolves into, is likely to last much longer than any of us thought or even think today. I mean, I think going back to when shelter in place started here in California, I didn't anticipate we'd still be doing it as we approach the end of May. And I think the economic recovery will be like that as well. So I think the number one goal of every company right now should be to preserve their cash for as long as possible, with the goal of keeping their business alive through this period until ever we make it to whatever the new normal turns out to be.
That's absolutely well said. And I think that follows very much the similar advice we're giving to people individually in their own personal finances is very much one and the same. And the one thing that I want to circle back to before we wrap up is that beginning of the talk was about financial plans or talking about financial plans that work, and we chose that for a reason because a lot of financial plans, whether it's on our business or personal side of things, generally are done for some reason that or for some event that had occurred and then it ends, and then the financial plan just sits there, as you said, collecting dust. And so I'm glad that you talked about the dynamic nature of financial planning and the value of having it as a part of the operations of the business and guides our thinking. And, as I think back to our conversation, I think the big takeaway that at least I'm taking from this talk is that, engaging someone like yourself is in part strategic and forward looking to help us make better directional decisions. But there's also a lot of tactical benefits that I feel business owners would also get in having a fractional CFO guiding them as information becomes available and as we move through this time of otherwise difficult to see environment. And so I just want to say thank you for bringing those valuable insights and perspectives. And I want to see if there's anything else that you might want to share with our viewers and our listeners.
I think we've covered the main points, Roman. I think you've done a great job of summarizing it, and this has been a lot of fun. I'm glad I had a chance to do it, and I hope that the viewers out there get some benefit that they can apply to their own business or to businesses that they work with. So thanks for having me on today, Roman. I really enjoyed it.
It was great having you. I'm glad you came on. And before we go, can I share your contact information if folks want to reach out to you?
Absolutely. Yes. So
Is it
you want me to provide my email address? You have it on the screen, or?
I just put it up on the screen. It's your at cfostogo.com. J Greenhalgh at cfostogo.com.
You got it.
Well, great. We'll leave this up here for another second or two. And again, just want to say thanks again for coming on. It was wonderful to have you. Thanks for sharing your insights. And wishing you all well. And hope to get some clarity as we go through this time. And let's hope we won't have to be sheltered for too long, but we will respect whatever guidance we get and make the best decisions we can for ourselves, our families, and our businesses. So, Joe, thanks again.
Okay, thanks, Roman.
Bye, everybody.